All right, greetings. Hello. Today we are going to tackle and discuss double entry accounting. Briefly, what double entry accounting means is that whenever a company has to make a journal entry for a transaction, there must be at least two entries to it. Two accounts have to be affected. More specifically, there are two big rules for journal entries, and this is what double entry accounting is all about. The first rule: each journal entry must have at least one debit entry and at least one credit entry. Okay. So a journal entry could have 27 debits and then only one credit. That's fine. But it needs at least one debit and at least one credit. Okay. The second rule is that the total debits, when you add them together, must equal the total credits when added together. All right. So let's start. The best way to look at the double entry system is to look at a transaction and then tackle it. So I put up three brief examples here. We're starting with Apple. Apple Corp buys supplies for $5,000 that they pay for with cash. Okay. Whenever you see a transaction, your first thought should be, what accounts are affected by this transaction? What specific account titles? Okay, and I'm not saying assets, liabilities, or equity. All right. I'm saying specifically, is cash affected? Are accounts receivable affected? Is revenue affected? Is wages expense affected? So the best way to do this, until you're comfortable with the account, is to look at this cheat sheet. Okay. And see, the transaction said Apple purchased supplies that they paid for with cash. So if you're unfamiliar with specific account titles, which are these, okay, the ones that aren't in bold, if you're not familiar with them, then come to this cheat sheet and look, read the account titles and see. This doesn't have all the account titles that exist, but it has a lot of them, and see what makes sense. So if Apple purchased supplies, I see supplies right there, for cash, I see cash, we got two accounts. And it doesn't seem like there's any other account that would be logical for this specific transaction. So we have our two accounts, supplies and cash. Next, what we do is we tackle each individually. And we have to say, we have supplies and cash. Our supplies, is the balance of our supplies account increasing by $5,000 or decreasing? Well, if we're buying supplies, we're getting more supplies, so the balance of supplies is increasing. Now let's look at cash. Is cash, if we're paying for something with cash, is our bank account balance with all our cash increasing or decreasing? It's going to be decreasing because it's going out. Okay? Now what we do is, if you're good with these specific accounts and which of the big account groups they belong to, you could go ahead and make the journal entry, okay, based on what's happening, okay? If not, go back to the cheat sheet and look down here. So supplies are an asset account, okay? Assets are resources the company owns. We said the supplies are increasing because we're getting more. So when supplies are increasing and they're an asset, you debit supplies. So we're going to go to our journal entry and we're going to debit supplies for $5,000. Now we can do the same thing with cash. Go to the cheat sheet. Cash is an asset, just like supplies, but cash, we said, was decreasing. So when assets are decreasing, you have to credit them. So we're going to credit cash 5,000. And now we look. Journal entries must always, always have at least one debit entry and at least one credit entry. We have one debit and one credit, so we get that rule. Then the total debits must equal the total credit. 5,000 equals 5,000. So we're good. We're perfect. Okay. Now, This doesn't mean the journal entry will always be correct. As long as you meet those two rules, things could go wrong. But a journal entry should never ever exist where there's just a debit and no credit, or just a credit and no debit, or the debits total like $100,000 and the credits total $5. Okay, they have to equal, and there has to be at least one of each. Now, what if I said, just to show, remember the accounting equation from the very first topic of this class: assets equals liabilities plus equity. After every single journal entry that is ever created, this accounting equation must still remain in balance. Okay? So when we debit supplies, they're an asset account. Back to the cheat sheet. When an asset is debited, it's increasing. So we debited supplies, so we're going to increase assets by 5,000. But we credited cash. Cash is an asset. When you credit cash, which is an asset, you decrease the account. So it's going to decrease 5,000. So these two, you're increasing assets 5,000, but then you're subtracting 5,000. They cancel out. So that means after this journal entry, this accounting equation remains in balance. So it's good. That's what we want. If we only submitted a debit to supplies for 5,000 and we didn't do this credit, pretend the credit doesn't exist. So all we have is the debit to supplies for 5,000. We would be increasing assets, but then nothing else is changing. So if liabilities and equity remain the same, but assets just increase $5,000, this equation isn't going to balance. It's going to be 5,000 higher on this side because we're not doing anything on this side, or we're not counterbalancing the 5,000 increase on this side. So we want to make sure our journal entry has a debit and a credit, at least one of each. Okay? So I'm going to delete these two, and we're going to move on to the next one. Apple buys inventory that they pay for on account, totaling $25,000. So if we look at this, Apple buys inventory that they pay for on account. Okay, so here's a good example. Inventory isn't on here. Inventory is an asset account, though. So inventory would be over here. So they're buying inventory, so that's one account. They pay for on account. So they're not paying for it with cash. You got to look for the keyword on account. When you pay for something on account, you recognize accounts payable. This means you didn't pay for something and you're obligated to pay for it in the future. So accounts payable is the next account. And that's it. For this transaction, there's no other account. So if we are purchasing inventory, which is an asset, say we have a big stock room full of inventory, and we're buying $25,000 more of inventory, is the total value of our inventory increasing or decreasing? It's increasing. Accounts payable is a liability, so it's debt. It's debt that we owe someone else. So we're saying we're taking on more debt, pay $25,000. We're building up basically a credit card that says in the future we have to pay $25,000. So our debt is increasing. Okay. So we could build a journal entry from this now. Inventory is increasing. I said it was an asset, even though it's not on here, it's an asset. We could update this as we go along the course. Inventory is an asset. It's increasing, so we debit inventory. Now, just because accounts payable is also increasing doesn't mean the same thing happens because it's a different type of account. It's a liability. So we go to the cheat sheet, liabilities, accounts payable. When liabilities are increasing, you credit the liability. So we're going to credit accounts payable. I'm going to abbreviate it AP for room, 25,000. Okay? So we have at least one debit and one credit, our journal entry balances. And we have total debits, 25,000, total credits, 25,000. So they equal. Okay? Now let's bring it to the accounting equation quick. Inventory is an asset. When you debit it, we just said you're increasing it. So assets are increasing 25,000. Now, in this same journal entry, something has to happen to make sure this stays in balance. Either assets now have to decrease 25,000 with a credit, or something on this side has to increase 25,000 as well. Well, accounts payable is a liability, which we said was increasing with a credit, so liabilities are increasing 25,000. So assets increase 25,000, but liabilities increase 25,000. So that means the equation would definitely equal. Okay? So that's good. And now I'll go do this last one a little quickly just in case it's repetitive. Apple provides a service and earns $10,000 in cash. So when you provide a service, you could call it two things: fees earned or service revenue. So again, they're providing something, so they're earning money for something they provided. That's a revenue. So fees earned, and they're receiving cash, the problem says, so cash. Cash is easy. When you receive cash, $10,000, increase. Fees earned, whenever you earn a revenue, it means that your revenue total is increasing. Okay? So now let's look. Cash is increasing. Cash is an asset. Assets increase with the debit. So we're going to debit cash. Oh, excuse me. Debit cash. 10,000. Revenues are increasing. Fees earned is a revenue. Okay. When revenues increase, look down here. Revenues increase. You credit it like a liability. Credit. Fees earned. $10,000. And now we can go ahead. We have a debit. We have a credit. Meet the first rule. Total debits 10,000. Credits 10,000. Second rule. Now we can go ahead and update our cash, our accounting equation. So cash is an asset which we debited. It's increasing. So assets are increasing 10,000. Fees earned, they're a revenue. Revenues and expenses are part of equity. We credited fees earned, which means it's increasing. So equity is increasing 10,000. So what happened to the left side of the equal mark was an increase of 10,000. What happened to the right side was an increase of 10,000. So the left and the right equal. Okay, they're in balance, and we are good. All right, so the journal entry matches. So this is how double entry accounting should be tackled. You look at a transaction, you find at least two accounts that are affected. Okay, you put them, what's happening, are they increasing or decreasing? Based on that, you could create your journal entry. Never submit me a journal entry that does not have at least one debit and at least one credit entry. Okay, even if they are wrong, if you use the wrong accounts, I'd much rather see a debit and a credit than just the correct debit account with no credit at all. Okay, and make sure the total debits equal to total credit. So check this over, look at the video, look back on some of your other stuff, and see if it makes sense.